G'day everyone. This is a follow-up session to our webinar on section 100A. We didn't get to a pile of questions, so I'm just going to run through what those questions were and a short little answer. I hope you get some value. So the first question was, does the ATO have an issue with the following example? A discretionary trust makes a distribution of $90,000 to an adult child. The trust doesn't pay the amount but leaves it as an unpaid entitlement. The $90,000 is then used by the discretionary trust to invest in shares. The $90,000 won't be paid to the child for 5 or more years when the child is ready to buy a property and needs a deposit. At that time, the shares will be sold to pay out the $90,000 UPE. Look, whether or not the ATO has an issue with it is always a little hard to say. I don't particularly have an issue. Where I think they will take issue is, what is the knowledge of that child? Do they know that they're owed $90,000? Did they get involved in the process of investment of that $90,000? Was it simply mum and dad's decision? They didn't really tell the child what was going on. They got their accountant to prepare tax returns and get the child simply to sign. So I think they have an issue around, is the adult child genuinely a part of the process of reinvestment, for want of a better term? If they are, I think there's no concerns there. It might be a different way to do it, maybe to put that 90,000K into a separate trust fund, for example. That may be a better approach. Personally, I don't have a significant issue with this one. So the next question, I have a scenario at the moment where the trust invests in ASX shares and all dividends are reinvestment. So usual dividend reinvestment program of 20 to 30K per annum. Distributions are made to the grandparents, but the funds are not paid because obviously the cash has been reinvested. The financials show beneficiary entitlements, and there's no dispute that this will be paid at some point in the future. Under the updated guidance notes, is that now a problem? And if it is, essentially the investments will need to be liquidated each year or the dividend reinvestment program stopped, as a question. The short answer is no, I don't see a problem with that at all. Because the entitlement is genuine, what the ATO have a problem with is distributions to either children or mum and dad or their parents, and the money being used by the controllers of the trust. In this scenario, albeit that the grandparents they appear to have full knowledge of the dividend reinvestment program, their entitlement is genuine. I don't have an issue with this at all. And the next question, in PSLA 2012/2. The ATO can see that the trustee at the end of a given year is the entity that has the tax-related liability for that income year. If concerns exist about the so-called sins of the past leading to a retrospective Section 100A assessment, could it be prudent from a risk mitigation standpoint to insert a new corporate trustee and then deregister the former corporate trustee? Yeah, I mean, that's certainly an option. Questions would be raised about potentially why that process was undertaken and whether there was some scheme to avoid that liability. You're sometimes better off in that position, arguing that position, than the trustee that is the current trustee landing in that situation. What you will find, if the amount is significant enough, the ATO will apply to the court to re-register that former current corporate trustee and then attempt to put it back into liquidation. In that scenario, that company in liquidation would have a claim or an equitable entitlement to be reimbursed from the trust fund for the tax liabilities. ATO's only going to go to that point where there are significant trust assets available to me to claim, and the costs of doing that process and the likelihood of success outweigh, or don't outweigh the benefit that they might get from that distribution. The next question, distributing to lost trusts within a family group when other beneficiaries have taken drawings from the trust and the lost trust has not received its distribution in cash. Is this an area of risk under these new rules? Obviously, distributing to a lost trust within a family group will minimise tax within the group. So is it likely the ATO will see this as tax avoidance as the tax is minimised and tax paid at a lower rate, or not at all if there's a, if the trust has enough losses to soak up? There is an example in the ruling in relation to trust losses. The example is where a person outside the family group has access to trust losses, and then there's an agreement effectively for that person to receive a distribution of income, use their tax losses, and divert some of the money, perhaps the lion's share, back to the controllers of the trust. In this scenario where there's lost trusts, my view or our view is that will be fine. If they're lost trusts within the group, they've got appropriate family trust elections, that certainly wouldn't bring Section 100A. At the end of the day, it would make sense, rather than the lost trust not receiving the distribution in cash, it would make sense to fund that money through. If there were reasons why that shouldn't happen, we could revisit that position, but my view would be simply pay the distribution, use the losses, and then either invest in that trust or perhaps vest that trust and pay the capital back to the other trust or to beneficiaries. Next question is, leaving unpaid entitlements in the trust and reinvesting the money is akin to a dividend reinvestment scheme. It should be ordinary commercial dealing. Yep, I agree. That the area of concern for the ATO has is the knowledge element. Do the adult children have knowledge, or the parents have knowledge of what's going on? If they understand it, like Adrian said in our seminar, why shouldn't adult children be able to reinvest in their family wealth? It's all about knowledge. If the kids are knowingly saying, well, this is the reason we're doing this reinvestment program, then we would argue that's an ordinary family dealing. Where the kids have no knowledge, and that comes through regularly, and I've said it a number of times, where the kids have no knowledge, that's where problems will arise. So it's about getting the kids on board. A couple more questions. What are your thoughts on issuing special class shares in existing bucket company to adult beneficiaries? Look, I'd need to know a bit more about the circumstances, but at the end of the day, issuing special class of shares should be done cautiously and make sure you cover off on. There's about 10 different areas of the law that need to be looked at, and I probably need to know a little bit more behind, the purpose of this. In terms of Section 100A, not sure that 100A would apply to that transaction because you do need to make someone presently entitled to income of a trust. So it kind of doesn't really apply in that scenario. The next one, is this really stopping us freely distributing with tax being the main reason for flexibility? I don't think it does. But what the ATO are trying to stop is a circumstance where we freely distribute to people who never receive the benefit and either don't know or don't, willfully shut their eyes and don't actually ever receive a benefit. What the ATO says is if there are adult children, they have no knowledge of their entitlement. They might know something's going on because mum and dad have done their tax returns for them, but they never receive any of the benefit. Mum and dad take all the benefit for themselves. In those circumstances, the ATO says, well, mum and dad should have paid tax on the original amount. They can't, other than under Part 4A, they can't assess mum and dad, so they're using 100A as the stick. And the final one is there an issue distributing to parents to reduce income tax? Look, again, I probably sound a bit like a broken record, but no, there isn't. But it's about what happens to the money. The ATO, again, have an issue if the parents never receive a cent and all the money goes to the kids. That's where the ATO will look at those circumstances and consider using 100A. So look, thank you for that. I thought it was worthwhile and simpler for me to get online, do a quick video and put through any questions. Obviously, if you've got any other questions, get on the phone to us or jump on our website at www.clearyhoare.com.au and shoot through any questions you might have. This video will obviously be up online. So thank you very much and catch you next time.